Hey, Boris Moshev here, and welcome to another tax strategy video. And in this video, we're going to talk about how to not pay investment taxes on your tax return. This is a little sneaky tax that you have no idea about that is being calculated on your taxes. And in this video, we're going to talk about how to not pay it, right? So first of all, we're going to talk about what is really NIT, which is the net investment income tax, right? Why is it there and why should you be paying it? We're going to go through a quick example to understand it. Then we're going to jump into how to not pay this tax. And I will share with you two case studies that we did in the last 30 days where we were able to get our clients back $11,000, client number one, and $30,000 by amending their tax returns. And we're going to talk about that if you ended up paying this tax yourself. We're going to talk about how you can amend it and how you can get this money back. Ready? Let's go. Okay, awesome. Before we continue, just an FYI, if this is your first time on my YouTube channel, every Tuesday I release a tax strategy video. So go ahead and click subscribe button so you are notified every time I release a tax strategy video that will help you pay less in taxes. Now, what is a NIT? NIT stands for Net Investment Income Tax. It is a 3.8% tax on your tax return. Now, in order for you to know why you're paying this why you're paying this tax, we really have to understand the background of it. So in 2013, when President Obama enacted the Affordable Care Act, right, ACA, also known as Obamacare, a lot of people know it as Obamacare, but when they enacted this, they basically made a law that anybody is eligible to receive health care. And if people have pre-existing conditions, they can apply outside of the enrollment period and all of these things, right? Insurance companies were like, whoa, you can't do this, it's going to hurt us. They said, don't worry, we're going to make sure you get the funding that you need. So they did one of the two things, right? One of the few things, but we're going to talk about one of the two things. If you remember, it was back in the day in 2013, 14, and 15 taxes, right? They required you, or the government required everybody to have health insurance. Whether you want it or not, young or old, whatever that is, you were required to have a health insurance. Why? Because the government said, you know what, we need to make sure the insurance companies are getting paid because a lot of people not qualify for health insurance. And if you did not get health insurance, you were penalized. You probably remember those days where you paid penalty. I remember we didn't have it. I had to pay penalty, right? The second thing they implemented is what's called a NIT, Net Investment Income Tax. This tax was created to really fund the ACA, the Affordable Cares Act, right? They said that, you know what, the government said, we're going to have something that's called a NIT, and we're going to tax the rich. And the government considered somebody who's rich, if you're single making over $200,000, if you make more than that, we're going to tax you on the NIT, right? And you are rich, right? If you're married, it was $250,000 if you make more than that. And we're going to talk about how that works in a second. But they basically wanted to fund the ACA. Now, the net investment income tax, now you're going to be blown away. If you're watching this video and thinking, you know what, I don't have any investments, I only have a business, stay on, because this applies to your business as well. And we're going to talk about how not to pay that, right? So back to us. The NIT is an addition to capital gains tax. So everybody knows we have a favorable capital gains taxes. If you sold long-term assets, right, which you held for more than 12 months, you don't pay more than 20% capital gains tax, assuming you're on the higher end of the bracket. Well, the NIT tax is addition to that. So a lot of people say, oh, our capital gains tax rate, the maximum is 20%. No. It is 23.8%. Okay, why? Because we have this dreaded silent 3.8% tax. It is calculated automatically on your tax return, okay? Now the government says, all right, so now we want to fund the ACA, so we're going to tax you 3.8%, and this is how we're going to calculate the tax, the government says, right? The government says, we're going to take your modified adjusted gross income. Modified means, you know, we're not going to get into details, but an adjusted gross income, right? How much is your gross income? Not including your W-2 salary and business income, so other things that go into counting your income. We're going to take the lesser of your modified adjusted gross income or any excess of your investment income above these thresholds. I'll talk about an example, make it easier to understand. And that's it. They slap the 3.8%, bam, on that. Now, the government says if you got investment income, if you have rental income, and if you have passive businesses, right? These are the most typical things that you pay this tax on. Passive businesses means businesses that you do not participate in. Now, we're going to talk about how not to pay this tax on your rental and on your businesses. Even though if it's not passive business, you still end up paying this tax. I will explain to you how it's mind-boggling, and we're going to talk about how not to pay that, right? So the government says that's it. We're going to fund the ACA since 2013. Of course, when President Trump became president, he removed the penalty and he removed the requirement, right? Those things are no longer there. So even more so, they need money, right? But the net investment tax didn't go away. That has not been repealed from the tax code. It is still there. That means you're still paying this tax, right? Now, you might say, well, Boris, again, I don't have any investment income, but if you have a business, you're probably paying this. Now, let's kind of walk through an example, then we're going to talk about the rest of the items over here. So let's say Bob, right? He's a single individual. He makes $250,000 on a W-2. And his investment income is $100,000. Let's assume he makes investments, he invests in stocks, whatever that may be, right? So his total income, his MAGI, so to speak, modified adjusted gross income, is $350,000. So the government says you take the lesser of $100,000 of his net investment income. I'm walking you through this example, ladies and gentlemen, so you understand and you can pinpoint exactly where you pay this tax in your tax return and have your guy amended, okay? Now, back to our example, $100,000 in investment income, right? Or an excess of these thresholds. Now, Bob is single, so $200,000, the excess, right, of $200,000 because he makes $350, the excess is $150, right? He makes over $150,000 over 200, right? So the excess is 150, right? Over that. So the government says take the lesser of these two numbers and you pay 3.8%. As you see, Bob is not happy that he now has to pay extra 3.8% tax on it. Now, because look, this is his investment income. He already paid either short-term capital gains taxes or long-term capital gains taxes, right? He paid state and city federal taxes, and now this extra tax is being slapped on him, so to speak, and it's just being auto-calculated and added to your total tax on your tax return. A lot of times when you ask your tax preparer, by the way, if you have a tax preparer and you do not have a tax planner, you're overpaying in taxes, okay? So when you're asking your tax preparer, why is my tax bill again high again? They won't even explain to you that there is something that's called net investment income tax, and I will explain that to you, why they can explain it to you in these case studies. Now that we understand what is the net investment income tax and we walked through example, right? Let's go into how not to pay the net investment income tax. And to be honest with you, you'll probably be surprised by this answer, but the answer is knowledge. You really have to understand what this tax is. Now you might say, well, Boris, why should I understand it? I've got an accountant who I pay money on to prepare my taxes. That is true, but unfortunately, accountants don't know how this tax works. A lot of them don't. Maybe I'm attacking too many of them, but it's true. I'll walk you through case studies, right? You have to be like, when you are reviewing your taxes with your preparer, like you have to understand something. You're going out to hunt every day to go hunt and bring the money back. At the end of the year, you trust an individual with your taxes. Know who you trust, right? And you gotta know some of the stuff too, like because you're trusting somebody with your finances. Now you have to understand what are you paying the 3.8% tax on. Now investments is pretty easy. You've got dividend income, interest income, capital gains tax, great. Even passive businesses where you do not materially participate in the businesses. Like for example, you went into a partnership with someone and you're like, hey, I'm just putting in money and I'm not going to participate, okay? I'm not gonna have be involved in day-to-day. So, okay, great. So that is considered passive business, and that is considered investment income. So that means what? You pay 3.8% tax on that. Now, that's simple, that's easy, right? But what if you have rentals? Now, generally speaking, you do pay net investment income tax on your rentals, right? So, but what type of rentals, right? Net investment income tax on your rentals. Now, what type of rentals? If you are an investor, for example, you have few properties, you own a business, you operate a business, but you bought few properties for yourself, and you have a net profit from your rentals, and you exceed these income thresholds, that's pretty easy. You pay that. But a lot of people that do qualify as a real estate professional under IRS definition, what does that mean? So there are certain class of individuals, for tax purposes, they're considered real estate professionals. It doesn't mean that they have a license to go sell real estate. It's just IRS defines them as real estate professional. Those individuals are the ones that spend more than 50% of their time in real estate activities, right? Just kind of simple terms here. And at least 750 hours is spent in real estate, okay? They are considered real estate professionals. And if they have rental property, okay, if they have a rental property which generates net income, and because real estate professionals are considered to be in a trade of business, they do not pay the 3.8% tax. Now you might say, well, Boris, hold on a second. I have a business that is not real estate, but I own a business, whatever that may be, and I receive a K1. Do I have to pay 3.8% net investment income tax? No, you don't, but you most likely are on your taxes. And we're going to talk about it in the case studies, okay? But coming back to our net rental income, right? When you have a trade or business that you participate in, even though you receive K1s, whether as a partner or from your S corporation, you do not pay 3.8% tax on that. You might be paying it, and we're going to talk about that in a minute, okay? You also do not have to pay, in most cases, the net investment income tax on your short-term rentals. Now, short-term rentals falls into two categories. It could either be a passive income on Schedule E or a business income on Schedule C. But even if it falls on Schedule E, it may not always be considered passive income. And you do not have to pay 3.8% tax on it. Your job right now, after you watch this video, is question your accountant, right? Your preparer, which you should not have a preparer, you should have a planner, right? Do I pay this tax? How is it calculated, and what income are you calculating it? Okay? Now, also, any businesses, like I mentioned earlier, from which you receive K1s, in a business that you participate, your businesses, right? Even if K1 is considered an investment income, so to speak, because usually you would receive a K1 if you have investments in other businesses, but that's only if you don't participate in them, if it's passive business, okay? So this is not the entire list, because right now we're going to go into amending. We're going to talk about case studies, and I'm going to talk about how you can identify this tax on your tax return and what you can do to amend it. Okay, awesome. So now let's talk about amending your taxes, right? Let's talk about case studies that we did in this in my firm, and this will make clear picture for you how to identify it and what you can do. Now, I'm going to call this individual lady Sandra. Okay, she's an actual client, but I'm not going to disclose her name because I didn't ask for permission. But she basically, right, signed up with us, and we reviewed her returns, and we identified that she has a business, right, that she's renting. I'm sorry, I'll take it back. She has a business and she has a rental property. The business is located in her rental property, so she basically rents to herself, right? So IRS says, wait a second, you've got a real estate, but you're not a real estate professional. You have to pay the dreaded 3.8% tax. But if your real estate is part of your business, meaning to say you're 100% owner of the business, you're 100% owner of the real estate, or you and your spouse, right? They're considered self-rental. I always talk about other benefits of having a self-rental tax strategy, but this is another benefit. And the IRS says you don't have to pay 3.8% net investment income tax on a net rental income from this. Like, wait, what? Right? So when we reviewed her returns, we have identified, we reviewed the form, okay, that has the net investment income tax calculated, and we quickly noticed that her accountant did not check the proper box, right? And it really is a proper box. Like, when you've got somebody who's doing your taxes, they have to know what the hell they're doing, excuse my language. Because if it's just data entry, you've got a person who's putting the right numbers in the right boxes. So that person was putting the right numbers in the right boxes, but didn't he check off the proper boxes, right? Additional check marks, because you have to understand, we've got softwares preparing returns, right? Yes, softwares are really good. They do a lot of calculations, and sometimes we even learn certain things from a software. That's the honest truth, right? But you've got to still know what the hell you're inputting and what is your client situation, right? So this person didn't do that. And additionally, right? This even goes farther. They classify the business as passive business. So 1 year, they didn't check off the box that it's self-rental. Second year, they didn't check off that it's a self-rental and that it's her business. So they marked it as her passive business. And guess what? Quickly recalculated, said, by the way, lady, amending 2 years worth of your tax returns, IRS will just send you a check for $11,000. Because that tax, the 3.8% tax, was not supposed to be there. Now your job, when you're watching this video, be like, hey, hold on a second. Is my income over these thresholds? Do I have a business income? Number one, do you have a business income? And is your accountant accidentally calculating this tax on that business income? Because in case study number 2, this individual right here makes like $800,000 on a K1 from an S corporation. His accountant, 1 year, they did check off the box. That's what's mind-boggling. 1 year they checked off the box that, hey, this is his business. It's not a passive business, so he doesn't have to pay the 3.8% tax. But the second year, that same accountant did not. And bam, he was slapped with about $30,000 tax on his return. The guy didn't even know. And the accountant said, hey, you owe this much money, and my client paid it, okay? And now we actually have a meeting with this client tomorrow and let him know, hey, we found $30,000 for you. We're going to be getting it back for you, okay? Now, because it was incorrectly classified. So if you've got a business, and just because you've got a tax preparer, doesn't mean it wasn't done right. That's why kind of coming back here, I said how not to pay this tax is really knowing knowledge, right? And this seems like a complicated tax, but it's actually not. I don't think it should even be there, but that's just my opinion, right? But you've got to know this. We have so many taxes in the tax code because people say, oh, I'm at 37% bracket, or I'm at 35% bracket, or I'm at 25% bracket. But nobody talks about all these hidden other taxes, right? We have alternative minimum tax. We have net investment income tax. We have additional Medicare tax. We have a self-employment tax. You do know that all of that is being calculated silently on your tax return based on how your preparer is putting their numbers in the right boxes. They don't even put the right numbers in the right boxes sometimes. Okay, but I hope you're not that person, because when we did these in the last 30 days, like I was aware of this problem, right? That people have it. It was like in the last 30 days, we got 41,000, just like real examples. I'm like, I have to put this out there for people to know. Like, please question your accountant about this. Do you make more than this? You might not have. Here's the thing, those clients, these 2 case studies, they did not have an investment income. This tax was not even supposed to be calculated, but those boxes were not checked off. So please, don't be this Bob, okay? Well, this Bob actually followed the rules. He's accountant or whatever. But don't have this face, okay? You got to figure that out. Do not pay this net investment income tax if you don't have to. And I hope this was clear. Thank you so much for watching my video. Make sure to subscribe to the channel, okay? Please make sure to subscribe to the channel because, like I said, every Tuesday we release tax strategy videos. Thank you so much, and until the next time.